There is a ghost in your bank account. It's a silent partner in every financial decision you make, and its only goal is to bankrupt you. It doesn't use spreadsheets or analyze cash flow statements. It operates on a much deeper, more primal level. This ghost is your own emotion. It's the thrill that makes you buy a soaring stock at its absolute peak. It's the panic that makes you sell a world-class company at the bottom of a market crash. It's the envy that drives you to gamble on a speculative venture your friend is bragging about. It's the greed that whispers, "This time is different." And every single time, it is wrong. This emotional ghost has destroyed more wealth than every market crash in history combined. It is the single greatest enemy of the retail investor, the entrepreneur, the person striving for financial freedom. Yet, for nearly a century, one man has operated with a strange immunity to this ghost. Warren Buffett, the Oracle of Omaha, seems to have performed a financial exorcism, casting out the spirits of fear and greed from his decision-making process. How? The answer is shockingly simple, yet profoundly difficult. It's not a secret algorithm or a complex financial instrument, it's a promise. A promise made to himself, codified onto paper in the form of a checklist. A simple, rational, unbending list of criteria that a business must meet before he will even consider investing a single dollar. This checklist is his shield. It is the logical fortress that protects him from the emotional noise of the market, the seductive stories of Wall Street, and the treacherous whispers of his own instincts. While the world is reacting, he is reflecting. While the world is panicking, he is calculating. While the world is gambling, he is methodically working through his checklist. This is the final promise he makes to his own rationality before he acts. It is the secret to his entire philosophy, the foundation of a disciplined investing process that has built one of the greatest fortunes the world has ever known. Today, we are not just going to talk about this checklist. We are going to deconstruct it, reverse engineer it, and build it from the ground up. We will explore the 5 fundamental pillars, the 5 non-negotiable questions that form the basis of his investment process. Each pillar is a chapter in the manual for defeating your emotional ghost. Each one is a step toward transforming your own stock picking from a chaotic, anxiety-ridden gamble into a calm, professional, and profitable operation. This isn't just about how to invest. It's about rewiring your brain to think like the most successful investor in history. It is a masterclass in risk management, trading psychology, and long-term portfolio growth. It is the blueprint for beating the market not by being smarter than everyone else, but by being more disciplined. This is the path to true wealth management, the kind that leads to lasting financial freedom. So let's begin. Let's build the shield. Let's make the promise. Our journey into the mind of Warren Buffett and the construction of his rational fortress begins with the gatekeeper, the very first question on any investment checklist, the principle so fundamental that without it, all other analysis is useless. This is the concept of the circle of competence. It is the simple yet profound discipline of only investing in businesses that you genuinely and deeply understand. It sounds deceptively easy, but in a world that bombards us with stock tips, complex technologies, and the siren song of the next big thing, it is perhaps the most violated principle in all of finance. It is the first checkbox, and for most people, it's the first one they ignore. To truly grasp the immense power of this rule, we must travel back to the late 1990s. The world was in a frenzy. It was the dawn of the internet age, the dot-com bubble. A new economy was being forged in silicon and code, and Wall Street was its high priest. Companies with no profits, no tangible assets, and often no coherent business plan were seeing their stock prices multiply by 10, 20, even 100 times. Analysts, news anchors, and everyday investors were convinced that the old rules of business were dead. This was a new paradigm. And in the middle of this euphoric madness, Warren Buffett looked like a relic. He was the dinosaur who didn't get it. Berkshire Hathaway, his investment vehicle, was dramatically underperforming the market, While tech stocks were doubling every few months, Berkshire's portfolio of insurance companies, candy makers, and furniture stores was plodding along. The pressure was immense. Shareholders were grumbling. The media was relentless. In December of 1999, the influential financial magazine Barron's published a scathing cover story with the headline, "What's Wrong, Warren?" The article portrayed him as a man out of touch, a has-been whose simple, value-based approach was obsolete in this brave new world of technology. They mocked his refusal to invest in the titans of the new age, companies like Microsoft, Intel, and the hundreds of smaller internet darlings. And what was Buffett's defense? What was his complex rebuttal to the charge of being behind the times? It was devastatingly simple. He said, "I don't understand them." He didn't say they were bad businesses. He didn't predict they would fail. He simply stated that they fell outside his circle of competence. He couldn't confidently project their earnings and competitive position 10 or 20 years into the future. He couldn't explain their technological advantages in simple terms. And because he couldn't do that, he could not, under any circumstances, check the first box on his list. So he did nothing. He sat on his hands and watched as others got fantastically rich on paper. He endured the ridicule and the doubt. His disciplined investing process demanded it. He was making a conscious executive decision-making choice to prioritize clarity over popularity. And then, the bubble burst. Starting in March of 2000, the Nasdaq, the epicenter of the tech boom, began a catastrophic collapse. The darlings of the new economy went bankrupt. Companies that had been worth billions were suddenly worthless. Trillions of dollars of shareholder wealth evaporated. Investors who had bet their life savings on dot-com stocks they didn't understand were wiped out. And Warren Buffett? He was fine. Berkshire Hathaway's cash pile, which had seemed like a foolishly conservative position just months earlier, was now an enormous war chest. The ghost of emotion, the FOMO, the fear of missing out, had tempted an entire generation of investors into a minefield, and Buffett had avoided it simply by refusing to step outside the small patch of ground he knew intimately. His adherence to the circle of competence didn't just save him from losses, it positioned him to buy world-class businesses at bargain prices in the aftermath. It was a masterstroke of risk management, born not from a brilliant prediction, but from a humble admission of ignorance. That is the power of the first checkbox. It's not about being the smartest person in the room. It's about knowing the limits of your own knowledge and having the discipline to never ever cross them. The psychological principle that Buffett's circle of competence so elegantly neutralizes is one of the most pervasive and dangerous cognitive biases in human decision-making, the Dunning-Kruger effect. Coined in 1999 by psychologists David Dunning and Justin Kruger, this effect describes a phenomenon where individuals with low ability or knowledge in a particular domain systematically overestimate their competence. In simple terms, they are too ignorant to recognize their own ignorance. This is the very engine of amateur investment disaster. A retail investor reads a few glowing articles about a new gene-editing technology, watches a charismatic CEO on a news program, and suddenly believes they have a deep understanding of the biotechnology industry. They mistake familiarity with expertise. They don't know what they don't know. They are standing at the peak of what Dunning and Kruger called Mount Stupid, a place of high confidence and low competence. And it is from this treacherous peak that they make their most reckless investment decisions. This is amplified by another powerful bias, the availability heuristic. Our brains are wired to make judgments based on information that is easily recalled, not necessarily what is most accurate or important. A hot stock tip from a friend, a ticker symbol flashing across the television screen, a company whose product you happen to use. This information is readily available and feels salient. It pops into our mind effortlessly. The hard work of reading a decade of annual reports, understanding the competitive landscape, and analyzing the balance sheet is not readily available. It requires deliberate, slow, and difficult effort. The emotional ghost of investing loves this shortcut. It whispers, "This is easy. You've heard of this company. People are talking about it. That's all you need to know." The circle of competence is a brutal, systematic tool for overriding this mental laziness. It forces you to move beyond the easily available information and confront the true depth of your knowledge, or lack thereof. Think about the trading psychology at play during a bubble. A story emerges: the internet, electric vehicles, artificial intelligence. This story is simple, compelling, and emotionally resonant. The Dunning-Kruger effect kicks in, with millions of people feeling like they understand this new paradigm. The availability heuristic ensures that all they hear and see are stories of people getting rich from it. This creates a feedback loop of social proof, where everyone believes it because everyone else believes it. The circle of competence acts as a circuit breaker. It introduces a moment of mandatory, personal, intellectual honesty. The question is not, is this a good story? The question is, do I, personally, understand this business, its technology, its customers, and its competitive dynamics better than the majority of other people analyzing it? For 99% of hot story stocks, the honest answer is no. By forcing this moment of self-awareness, Buffett avoids being swept up in the collective delusion. He short-circuits the Dunning-Kruger effect and the availability heuristic before they can hijack his investment process and lead to catastrophic errors in capital allocation. So how do we translate this powerful psychological defense into a practical tool for the average investor? How do you build your own blueprint for defining and respecting your circle of competence? It's a deliberate process, an active construction of your intellectual boundaries. Here is the 5-step mental model to make this abstract concept a concrete part of your investment checklist. First, you must conduct a professional audit. Take out a piece of paper or open a new document and write down the industries you have worked in throughout your career. What business do you understand from the inside out? If you're a software engineer, you have a massive head start in understanding software as a service companies. If you're a doctor, you can analyze medical device companies with a depth a Wall Street analyst never could. If you're a logistics manager, you understand transportation and supply chain businesses. This is your core competency, your unfair advantage. List the specific knowledge you have. Understanding customer needs, regulatory hurdles, key performance indicators, the competitive dynamics. This is the bedrock of your circle. Second, perform a hobbyist audit. What subjects are you deeply passionate about outside of work? Are you a car enthusiast who understands the automotive industry inside and out? Are you a gamer who has a nuanced understanding of video game publishers and hardware makers? Are you a home cook who intuitively gets the brand power of certain food companies? Deep, sustained interest over many years often leads to a level of expertise that rivals professional knowledge. Be honest about it. This isn't about what you casually read about. It's about what you are genuinely obsessed with. This expands your circle beyond your profession. Third, apply the explain it to a child test. This is the ultimate filter. Take any company you are considering investing in. Now imagine you have to explain it to an intelligent 12-year-old. Can you, in simple, clear language, explain exactly how this company makes money? What product or service it provides? Who its customers are? And why its customers choose it over its competitors? If you find yourself using jargon, convoluted explanations, or saying things like, they do some complicated cloud stuff, you do not understand the business. It's outside your circle. A truly understood business can be explained simply. Fourth, for any company that passes the first 3 tests, you must now map the industry. You cannot understand a single business in isolation. You must understand its ecosystem. For the company in question, can you name its top 3 competitors without looking them up? Can you articulate their primary strengths and weaknesses relative to your target company? Can you identify the major secular trends, the tailwinds and headwinds that will affect the entire industry over the next decade? If you can't sketch out this competitive map, your understanding is superficial. You only see the tree, you don't see the forest. Finally, and most importantly, you must build the too hard pile. This concept comes directly from Charlie Munger, Buffett's longtime partner. As you analyze companies, most of them will fail these tests. When they do, they go into the too hard pile. This is not a research later pile. This is not a keep an eye on it pile. It is a pile of definitive no's. The act of physically or digitally placing a company in this pile is a powerful psychological ritual. It reinforces the discipline of saying no. Your success as an investor will be defined far more by the bad businesses and overpriced stocks you avoid than by the winners you pick. The too hard pile is where you systematically discard your future mistakes. By following this 5-step blueprint, you transform the circle of competence from a vague idea into a rigorous, actionable part of your investment checklist. Now let's explore the antithesis, the path walked by the 99% of investors who are perpetually led astray by their emotional ghosts. This is the path of the story stock investor, the person whose portfolio is a collection of exciting narratives rather than a collection of well-understood businesses. Their investment process is not driven by analysis, but by FOMO, the fear of missing out. They hear a story about a revolutionary new technology, a societal shift, or a product that's suddenly everywhere, and their greed impulse overrides any rational thought. They don't have an investment checklist. They have an emotional trigger list. The dot-com bubble is the quintessential example of this folly on a mass scale. Millions of people, from seasoned professionals to taxi drivers, poured their life savings into companies like Pets.com, Webvan, and eToys. The story was intoxicating. The internet was changing everything, and these companies were on the vanguard. Did any of these investors truly understand the brutal economics of online pet supply delivery or the razor-thin margins of grocery delivery? Did they analyze the logistics, the customer acquisition costs, the competitive landscape? Of course not. They bought the story. They saw their neighbors getting rich, they read the euphoric headlines, and they jumped in, completely ignorant of the businesses they were funding. They were investing far, far outside their circle of competence. The result was a level of capital destruction that ruined lives and set back a generation of investors. This pattern repeats itself in every market cycle. In the 2000s, it was housing and complex financial derivatives. People invested in things they couldn't possibly understand because the story was, real estate never goes down. In the 2010s and 2020s, you see it in cannabis stocks, where the story of legalization overshadowed the reality of a commoditized agricultural product with crushing taxes and regulations. You see it in speculative biotechnology companies, where investors bet millions on the outcome of a Phase 2 clinical trial without having any ability to interpret the scientific data. They are not investing, they are gambling on a press release. You see it in meme stocks, where the story is simply about collective action, divorced entirely from the underlying business fundamentals, the 99% chase narratives. They confuse a popular product with a good investment. They mistake a rising stock price for a sign of a healthy business. Their portfolio becomes a graveyard of exciting ideas that were terrible businesses, all because they never stopped to ask the first most important question on the checklist. Do I truly understand this? Their feelings bankrupt them because their feelings are drawn to stories, not to the boring, methodical work required for successful stock picking. The direct financial connection between strictly adhering to your circle of competence and your long-term portfolio growth is profound and multifaceted. It's not just a defensive measure, it is a powerful offensive strategy that manifests directly on your account statement. Firstly, it dramatically reduces the frequency of unforced errors. In investing, as in tennis, most points are lost, not won. The typical retail investor's portfolio is often crippled not by missing the next Amazon, but by owning a few catastrophic losers, the torpedo stocks that go down 80, 90, or 100%. These are almost always businesses the investor did not truly understand. They missed a key risk factor, a change in technology, a new competitor, a flawed business model. By staying within your circle, you have a much deeper, more intuitive grasp of the primary risks. You can see the torpedo coming. This dramatically lowers portfolio volatility and, most importantly, protects you from the permanent loss of capital, which is the cardinal sin of investing. Secondly, Operating within your circle gives you a significant informational and analytical edge. When you deeply understand an industry, you can interpret news and data differently than the market. While others are reacting to a negative headline, you might understand that it's a temporary issue that doesn't affect the long-term prospects of the business. This gives you the conviction to buy when others are panic selling, or to hold steady when the market is volatile. This is how genuine market-beating opportunities are found. It's not about secret information. It's about superior insight into public information, an insight born from expertise. Finally, this discipline has a direct impact on your capital gains and overall wealth management strategy. A portfolio constructed of businesses you understand is a portfolio whose future earnings are more predictable. This predictability allows for more intelligent capital allocation. You have a clearer idea of which of your holdings are undervalued and deserve more capital and which are fully valued. This leads to better decision-making over time, which is the essence of building long-term wealth. It shifts you from being a speculator, hoping for a lucky break, to being a professional operator, making calculated decisions based on a deep understanding of your assets. Achieving financial freedom is not about hitting one home run on a stock you know nothing about. It's about consistently hitting singles and doubles on businesses you know inside and out, and avoiding the strikeouts that wipe you out of the game. The first checkbox, the circle of competence, is the discipline that makes this possible. Once you have established the non-negotiable rule of staying within your circle of competence, you arrive at the second and equally crucial checkbox on the investment checklist. This is the search for a durable competitive advantage, a concept Buffett famously popularized under the term economic moat. He thinks of a company as a castle, and the value of that castle is determined by the strength and width of the moat surrounding it, which protects it from invading competitors. A great business, in his view, is not just one that is growing quickly or has a popular product today. A great business is one that has a structural advantage that makes it incredibly difficult for rivals to attack its profitability. Checking this box means you have answered a critical question. Does this business have a deep, wide, and sustainable moat that will protect its profits for decades to come? The foundational anecdote that cemented this principle in Buffett's mind and transformed him from a pure cigar-butt value investor into a seeker of quality businesses is the story of See's Candies. In 1972, Buffett and his partner Charlie Munger were presented with the opportunity to buy See's, a well-loved California-based chocolate company. The asking price was $30 million, but Buffett, who had been trained by his mentor Benjamin Graham to buy statistically cheap stocks, was only willing to pay $25 million. The business was earning about $4 million pre-tax, so at $25 million, he was paying a multiple that was higher than he was accustomed to. He was on the verge of walking away. It was Charlie Munger who pushed him, arguing that See's was a different kind of asset. Its value wasn't just in its tangible assets, the factories and the stores. Its true value was in the intangible, in the minds of its customers. For decades, customers had associated See's chocolates with quality, nostalgia, and special occasions. Giving a box of See's was a gesture of affection. This powerful brand association gave the company something extraordinary: pricing power. They realized that See's could raise its prices by 10% every year, and customers would barely flinch. They weren't just buying chocolate, they were buying a feeling, a tradition. No new competitor, even one with a cheaper product, could replicate that decades-long relationship with the customer. This brand loyalty was the company's economic moat. Convinced, Buffett paid the $25 million. That decision was a watershed moment for Berkshire Hathaway. See's Candies has since generated over $2 billion in pre-tax earnings for Berkshire, all of which required very little additional capital investment. It became a gusher of cash that Buffett could then reinvest into other wonderful businesses. The lesson was profound. It is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. The quality of the business, defined by the strength of its moat, was the primary driver of long-term value. From that point forward, identifying a durable economic moat became a non-negotiable checkbox in his investment process, a prerequisite for any potential acquisition or stock purchase. The psychological principle at the heart of the economic moat concept is its power to counteract our natural tendency toward herd behavior and the bandwagon effect. Human beings are social creatures, and this instinct spills over into our investment decisions. We are drawn to what is popular, what is growing fast, and what everyone else is talking about. This often leads investors to pile into hot industries where competition is fierce and no single company has a lasting advantage. Think of the endless cycle of new social media apps, meal kit delivery services, or fast fashion retailers. They exhibit rapid revenue growth, which attracts investors like moths to a flame. But this growth is often profitless, as dozens of competitors engage in a brutal price war to capture market share. The herd mistakes growth for a good business, failing to ask the crucial question about defensibility. The search for an economic moat is a deliberate act of contrarian thinking. It forces you to ignore the noise of revenue growth and focus on the quiet, underlying structure of the business. It makes you ask questions like, why can't a competitor do this cheaper? What locks a customer into this company's ecosystem? What makes this brand more valuable than others? This analytical process is a direct antidote to the bandwagon effect. Instead of chasing the crowd into highly competitive, low-margin industries, you are systematically searching for businesses that are protected from the crowd. Furthermore, the moat framework helps to fight confirmation bias. Once an investor likes a company, they tend to seek out information that confirms their initial thesis. They'll focus on positive product reviews or rising sales figures. The moat analysis forces a more skeptical mindset. It requires you to actively look for weaknesses and vulnerabilities. You are forced to play devil's advocate and think like a competitor trying to attack the castle. This process of inverting the problem, thinking about what could destroy the business rather than just what could make it succeed, is a powerful tool for making more rational and less emotionally driven investment decisions. It's a core component of a professional trading psychology, shifting the focus from short-term excitement to long-term resilience. So how do we, as individual investors, apply this powerful mental model? How do we build a practical blueprint for identifying and evaluating economic moats? It's about having a classification system, a checklist within the checklist, to systematically identify the sources of a company's competitive advantage. There are 5 primary types of economic moats you should look for. First, intangible assets. This is what See's Candies had. It can be a powerful brand name that commands customer loyalty and pricing power, like Coca-Cola or Apple. It can be a patent that protects a pharmaceutical drug, or a key technology from competition for a period of years. Or it can be a government-granted license or approval that is difficult for others to obtain, like a license to operate a railroad or a waste disposal site. The key is that this asset allows the company to sell its products or services at a premium price, or with greater customer loyalty than its rivals. Second, switching costs. This mode exists when it is expensive, time-consuming, or risky for a customer to switch from one provider to another. Think about the bank where you have your checking account. Moving all your direct deposits and automatic payments would be a massive headache, so you stick with them even if another bank offers a slightly better interest rate. Enterprise software companies, like Microsoft or Oracle, are masters of this. Once a company builds its entire workflow around their software, the cost and risk of switching to a competitor are enormous. High switching costs lock in customers and create a very stable, recurring revenue stream. Third, the network effect. This is one of the most powerful moats of the modern era. A business has a network effect when its product or service becomes more valuable to each user as more people use it. The classic examples are credit card networks like Visa and MasterCard. The more merchants that accept Visa, the more valuable it is to cardholders. And the more cardholders who have Visa, the more essential it is for merchants to accept it. This creates a virtuous cycle that is nearly impossible for a new competitor to break. Social media platforms, online marketplaces like eBay, and stock exchanges also benefit from powerful network effects. Fourth, cost advantages. This moat allows a company to produce its goods or services at a lower cost than its competitors, enabling it to either undercut them on price or earn higher profit margins. This advantage can come from immense scale, which allows a company like Walmart to negotiate better prices from its suppliers. It can come from a unique, proprietary process that is more efficient than anyone else's, like the point-to-point flight system that gave Southwest Airlines a durable cost advantage for decades. Or it can come from access to a unique, low-cost source of raw materials. Finally, you must apply the invade the castle test. This is a powerful thought experiment. Imagine you are a brilliant entrepreneur with a blank check from a private equity firm. Your mission is to attack the company you are analyzing. How would you do it? What is their weak point? If you can easily come up with a viable strategy to steal their customers and erode their profits, then their moat is not as strong as you think. But if you struggle, if every angle of attack seems to be blocked by one of the moats we just discussed, then you have likely found a true corporate fortress. This blueprint transforms the search for a moat from a fuzzy concept into a rigorous, analytical process, a critical step in any disciplined investment process. Now let's turn our attention to the antithesis, the path of the 99% who consistently fail to appreciate the importance of a moat. They are the investors who are perpetually drawn to the siren song of growth in industries that are, by their very nature, economic minefields. Their portfolios are filled with companies that operate in brutally competitive, commoditized sectors where no one has a lasting edge. The classic example that Buffett himself used for decades is the airline industry. For most of its history, the airline industry has been a death trap for capital. The barriers to entry are relatively low. You just need to lease some planes. The product is a commodity. A seat from New York to Chicago is largely the same regardless of the carrier. As a result, the industry is plagued by vicious price wars. Whenever one airline tries to raise prices, a competitor undercuts them to gain market share. Customer loyalty is virtually non-existent. Travelers almost always choose the cheapest flight. This lack of a moat leads to boom and bust cycles, chronic unprofitability, and a long list of bankruptcies. Yet, time and again, investors pour money into airlines, seduced by the cyclical upturns and the apparent growth, ignoring the fundamental structural flaws of the industry. We see this same pattern in countless other sectors. The restaurant industry is another graveyard of capital. A successful restaurant concept is immediately copied by dozens of imitators. There are no switching costs and very little brand loyalty in the face of a newer, trendier option down the street. The retail apparel industry, with its fickle fashion trends and constant promotional pricing, is another moatless battlefield. The 99% of investors make a critical error. They confuse a good product with a good investment. They might love the food at a particular restaurant chain or the clothes from a certain retailer, and on that basis, they buy the stock. They fail to perform the moat analysis. They don't ask if the business is defensible. They don't ask if it has pricing power. They don't ask what will stop a competitor from doing the exact same thing next year. And so, they end up owning shares in fair to mediocre companies, locked in a perpetual struggle for survival, wondering why their portfolio growth is always stalled. They are investing in castles with no moats, and they are constantly surprised when they are overrun by invaders. The direct financial connection between a strong economic moat and superior investment returns is undeniable. A moat is not just a qualitative concept. It manifests in tangible, quantifiable financial metrics that directly drive portfolio growth and wealth management success. The most important of these is a high and sustainable return on invested capital, or ROIC. A company with a moat can consistently generate high profits from the capital it reinvests back into its business. A company without a moat may grow by investing more capital, but the returns on that capital are meager because competition erodes profitability. A high ROIC is the financial engine of compounding. It means that every dollar the company retains and reinvests is creating significant incremental value for shareholders. Furthermore, a wide moat leads to stable and predictable profit margins. A company with pricing power can pass on inflationary costs to its customers, protecting its profitability. A company in a commoditized industry has to absorb those costs, crushing its margins. This stability and predictability of earnings are what Wall Street, private equity firms, and intelligent investors value most. It reduces risk and makes the company's future cash flows more reliable, which in turn justifies a higher valuation. This is a key principle of risk management. The more predictable the earnings, the lower the risk of the investment. Finally, the presence of a moat directly impacts free cash flow generation, the lifeblood of any business. Because companies with moats don't have to constantly engage in value-destroying price wars or spend excessively on marketing just to retain customers, a larger portion of their revenue converts into cash that can be returned to shareholders through dividends and buybacks, or reinvested at high rates of return. This cash generation is the ultimate source of capital gains for long-term investors. When you add a company with a powerful moat to your portfolio, you are not just buying a stock, you are buying a resilient, cash-producing machine that is structurally designed to fend off competition and compound your wealth for years to come. That is why the economic moat is a non-negotiable checkbox. It is the dividing line between speculation and true, disciplined investing. After confirming that a business operates within our circle of competence and is protected by a durable economic moat, we arrive at the third checkbox on our investment checklist. This is perhaps the most qualitative and, for many, the most difficult to assess, yet Buffett insists it is just as critical as the first two. This is the evaluation of management. The question we must answer is this business run by honest, competent, and shareholder-oriented people? Buffett has famously said that he looks for three qualities in a manager: integrity, intelligence, and energy. And if they don't have the first, the other two will kill you. A business, no matter how wonderful, can be ruined by a foolish or dishonest CEO. Therefore, a systematic assessment of the people at the helm is an indispensable part of a disciplined investment process. To understand the weight Buffett places on this human factor, we must look at one of the most remarkable acquisitions in Berkshire Hathaway's history, the purchase of the Nebraska Furniture Mart in 1983. This was not a deal born from spreadsheets and discounted cash flow models. It was a deal born from an assessment of character. The company was founded by Rose Blumkin, a Russian immigrant who arrived in America unable to speak a word of English. She started the business in the basement of her husband's pawn shop with a $500 loan and built it into the largest and most profitable home furnishings store in the country, doing over $100 million in annual sales. Her business philosophy was simple and relentless: sell cheap and tell the truth. She was famous for her tireless work ethic, her fanatical focus on customer value, and her absolute integrity. Buffett had observed her for years and was in awe of what she had built. One day he went to see her. She was 89 years old at the time. He told her he wanted to buy the business. He asked her price. She gave him a number. He said done. He didn't ask to audit the books. He didn't bring in a team of lawyers to conduct due diligence. The entire deal, for a company worth nearly $60 million, was sealed with a handshake and a 2-page contract written by Buffett himself. Why? Because he had already checked the management box with the highest possible score. He knew that Mrs. B's character was the company's greatest asset. He trusted her completely. He knew she would never cheat a customer, and therefore she would never cheat a partner. This story, in its simple trust, stands in stark contrast to another event in Buffett's career, the Salomon Brothers scandal in 1991. Berkshire was a major shareholder in the investment bank when a massive scandal erupted involving illegal bidding in treasury auctions. The firm's management had not only allowed a culture of recklessness to fester, but had failed to act decisively when the wrongdoing was discovered. The very survival of the firm was at stake. Buffett had to step in as interim CEO to clean up the mess, dealing with regulators, Congress, and a terrified workforce. It was a nightmare that consumed his life for months. One experience showed him the immense value created by management with integrity, while the other showed him the catastrophic destruction wrought by its absence. These experiences forever cemented the management quality checkbox as a critical pillar of his investment philosophy. The psychological bias that a rigorous management check helps to overcome is the potent and misleading halo effect. This is our cognitive tendency to allow a single positive trait to color our overall impression of a person, group, or company. In the world of investing, this often manifests as the celebrity CEO phenomenon. A CEO might be charismatic, a gifted public speaker, or have a compelling personal story. They give great interviews and appear on the covers of magazines. The halo effect causes investors to see these positive traits and automatically assume the CEO is also a brilliant capital allocator, a prudent risk manager, and a person of high integrity. We are so dazzled by the halo that we fail to look for the horns. An investment checklist forces you to break this spell. It requires you to look past the charisma and systematically evaluate the CEO's actual track record and character. This is closely related to authority bias, our deep-seated tendency to obey and believe figures of authority. A CEO is a position of immense authority, and we are psychologically conditioned to trust what they say. When a CEO on a conference call presents a rosy outlook, our instinct is to believe them, not to skeptically question their assumptions. A formal process for evaluating management acts as a counterweight to this bias. It forces you to adopt a more adversarial stance, to verify their claims, and to judge them by their actions, not their words. The checklist makes you ask, what has this management team actually done with shareholder capital over the last decade? Not how good did the CEO sound on television last night. This shift from a passive, trust-based assessment to an active, evidence-based evaluation is a crucial step in developing a professional trading psychology. It protects you from being seduced by a compelling personality and grounds your decision in the objective reality of past performance and demonstrated character. So how do we create a practical blueprint for evaluating something as seemingly intangible as management quality? We can translate this into a 5-step mental model that any retail investor can apply. First, read the letters. Go back and read at least 10 years of the company's annual shareholder letters, written by the CEO. This is the single best window into the mind of management. Are they candid and straightforward, or do they speak in confusing corporate jargon? Do they take responsibility for mistakes and failures, or do they blame external factors? Do they speak about the business with genuine passion and a long-term perspective? Or does it sound like a generic report written by a committee? Great managers like Buffett or Amazon's Jeff Bezos write letters that are clear, educational, and brutally honest. Poor managers hide behind obfuscation and platitudes. Second, analyze the capital allocation track record. This is where the rubber meets the road. A CEO's most important job is deciding how to allocate the company's profits. There are 5 options: reinvest in the core business, acquire other businesses, issue dividends, pay down debt, or repurchase shares. You must analyze their history. Have their acquisitions created value, or were they expensive empire-building exercises that destroyed it? Did they repurchase shares when the stock was genuinely undervalued? Or did they buy them back at the top of the market? A key metric to look at is the company's long-term growth in book value per share or return on invested capital. Great capital allocation directly leads to growth in these numbers. This analysis separates the talkers from the doers and is a critical part of executive decision-making analysis. Third, look for skin in the game. Are the interests of management aligned with the interests of shareholders? The best way to check this is to look at the company's proxy statement. How much of their own net worth is tied up in the company's stock? A CEO who owns a significant amount of stock is much more likely to think like an owner. Conversely, a CEO who gets most of their compensation from a massive salary and cash bonuses, regardless of the stock's performance, may be incentivized to pursue short-term goals at the expense of long-term value. Fourth, apply the simple question test. Listen to a few of the company's quarterly conference calls with analysts. Pay close attention to how the CEO answers tough questions. Do they give direct, honest answers, even if the news is bad? Or do they dodge, deflect, and use vague corporate speak to obscure the issue? A manager with integrity is not afraid of transparency. A manager who is hiding something will often retreat into a fog of jargon. Finally, try to distinguish between passion and a paycheck. This is more art than science, but as you read their letters and listen to them speak, try to get a sense of their motivation. Do they love the business, the product, and the customers? Do they talk like a founder who has dedicated their life to the company? Or do they sound like a professional journeyman CEO who is just passing through on their way to a bigger paycheck? Buffett wants to partner with the first type. He wants managers who would continue to do their job even if they didn't need the money. This 5-step process provides a structured way to look past the halo and make a more objective judgment about the character and competence of the people you are entrusting with your capital. Now let's examine the antithesis, the path of the 99% who are repeatedly burned by their failure to properly vet management. This is the path of the investor who falls for the cult of the celebrity CEO. They become so enamored with the leader's public persona, vision, and charisma that they completely abdicate their responsibility to perform due diligence. They outsource their critical thinking to the leader's personality. We have seen this story play out time and time again with disastrous consequences. Think of Adam Neumann at WeWork. He was a master storyteller, a charismatic visionary who convinced some of the world's smartest investors that a money-losing office rental company was a world-changing technology platform. Investors who were captivated by his personality ignored the flashing red lights, the company's absurd financials, the clear conflicts of interest, and the CEO's erratic behavior. They bought the story, not the business, and were severely punished when the facade crumbled. Consider the case of Enron and its leaders, Ken Lay and Jeff Skilling. They were hailed as geniuses, innovators who were revolutionizing the energy industry. They were darlings of the business press. Investors who fell for the halo failed to dig into the company's impossibly complex and opaque financial statements. They failed to question how the company could be generating such smooth, predictable earnings in a volatile commodity market. They trusted the authority and charisma of the leaders, and in doing so, they walked straight into one of the largest corporate frauds in history. The 99% make this mistake over and over. They chase the hot hand, the CEO who is on the cover of every magazine, without asking the hard questions about capital allocation or integrity. They are drawn to leaders who promise the moon, who focus on promoting the stock price rather than building the underlying business. Their investment process is a search for a messiah, not a search for a competent and trustworthy partner. This emotional need for a hero makes them easy prey for charismatic but flawed leaders who ultimately lead them to financial ruin. The direct financial connection between the quality of management and your investment returns cannot be overstated. Superior management is not just a nice-to-have, it is a direct and powerful driver of capital gains and long-term portfolio growth. The most significant way this manifests is through intelligent capital allocation. Let's consider a simple example. A company generates $1 billion in free cash flow. CEO A brilliant capital allocator, sees that the company's stock is trading at 50% of its intrinsic value. He uses the entire $1 billion to repurchase shares, effectively buying back $2 billion of intrinsic value for the remaining shareholders. CEO B, a promotional CEO focused on empire building, uses that same $1 billion to acquire a rival company for 2 times its intrinsic value, effectively destroying $500 million of shareholder value in an instant. Over a decade, the decisions of CEO A will create a compounding machine that generates immense wealth, while the decisions of CEO B will systematically erode the value of the enterprise. This is the hidden engine of wealth creation or destruction that many investors ignore. Furthermore, management with integrity creates a culture that reduces the risk of catastrophic blow-ups. A company run by honest people is far less likely to engage in accounting shenanigans or cover up operational problems. This reduces the tail risk in your portfolio, the risk of a sudden, Enron-style collapse that leads to a permanent loss of capital. This is a critical aspect of risk management. Honest accounting and transparent communication allow you, as an investor, to have a much clearer picture of the company's true financial health, leading to better decisions. Finally, great managers who think like owners create a culture of efficiency and a focus on long-term value. This translates into higher margins, better returns on capital, and a more resilient business model. When you invest in a company, you are not just buying a collection of assets, you are entering into a long-term partnership with its management. Choosing your partners wisely is perhaps the most important decision you will make. It is the checkbox that separates investors who build lasting wealth from those who are constantly being surprised by the predictable failures of bad leadership. We have now worked our way through 3 critical pillars of the investment checklist. We've established that the business must be within our circle of competence, protected by an economic moat, and run by honest and able management. But even if a company clears all 3 of these hurdles, there is one final, brutally quantitative gate it must pass through before we can invest. This is the 4th checkbox, the margin of safety. This principle, the cornerstone of Benjamin Graham's investment philosophy and the one Buffett considers the 3 most important words in investing, dictates that you must buy a wonderful business only when it is available at a significant discount to its underlying intrinsic value. The question here is not, is this a great company, but is this a great company available at a price that provides both a high probability of profit and a low probability of loss? The most vivid and instructive story of the margin of safety in action is Buffett's investment in American Express during the Salad Oil scandal of 1963. American Express at the time was primarily known for its traveler's checks and credit card business, but it also had a lesser-known division that did field warehousing. This division would certify and hold inventory for companies, who would then use that inventory as collateral for loans. One of its clients was the Allied Crude Vegetable Oil Refining Corporation, run by a man named Tino DeAngelis. DeAngelis was running a massive fraud. His giant tanks, which were supposed to be filled with valuable salad oil, were mostly filled with seawater, with just a thin layer of oil on top. When the fraud was discovered, Allied collapsed, and the banks who had loaned money against the worthless collateral came looking to American Express to make them whole. The market panicked. Wall Street assumed that American Express would be on the hook for massive losses that could potentially bankrupt the entire company. The perception was that the integrity of the American Express brand was shattered. The stock price was cut in half, falling from over $60 to $35 per share. While the world was selling in a panic, Buffett engaged his rational, checklist-driven mind. He first asked, does the market's reaction make sense? He reasoned that the real value of American Express was not in its warehousing division, but in its powerful credit card and traveler's check franchise. The crucial question was whether the scandal had damaged that core business. So he did the work. He went out and observed. He visited restaurants and travel agencies. He talked to merchants and customers. He saw that people were still using their American Express cards and traveler's checks without hesitation. The scandal, while serious, was contained to a small part of the business and had not affected the consumer's perception of the brand. He then did the math. He calculated that the core business was worth at least $60 per share, its pre-scandal price. Even if American Express had to pay out the maximum possible losses from the salad oil fraud, the company was still worth far more than the $35 the market was asking. The difference between his conservative estimate of intrinsic value and the panic-induced market price was his margin of safety. Convinced, he invested 40% of his investment partnership's capital into American Express stock. Over the next 2 years, as the market realized its overreaction, the stock more than tripled. He made a fortune not because he was a genius at predicting the future, but because he had the discipline to buy a great business when it was on sale, protected by a massive margin of safety. The psychological demons that the margin of safety principle is designed to vanquish are among the most powerful in the investor's psyche: loss aversion and anchoring bias. Loss aversion, a concept proven by psychologists Daniel Kahneman and Amos Tversky, is the human tendency to feel the pain of a loss approximately twice as powerfully as the pleasure of an equivalent gain. When a stock is falling sharply, as American Express was, loss aversion kicks into overdrive. The fear of further losses becomes overwhelming, compelling investors to sell at any price just to stop the pain. This collective fear is what creates market panics and pushes prices far below rational valuations. The margin of safety is a tool of pure rationality that allows an investor to override this primal fear. By anchoring your decision on a calculated intrinsic value, not on the fluctuating stock price, you can view a falling price not as a threat, but as an opportunity to increase your margin of safety. This is where it combats the second bias, anchoring. When a stock has fallen from $60 to $35, many investors anchor on the old price of $60. They see it as a broken stock and are afraid to touch it. Others anchor on the falling price itself, thinking, if it's dropped this much, it must keep dropping. Buffett did the opposite. He anchored his analysis on the underlying value of the business. The stock price was just a reference point, an offer being made by a manic depressive market. The discipline of calculating intrinsic value first, before even looking at the price, is a powerful technique to prevent your judgment from being anchored by the market's irrational emotional swings. It creates a logical firewall between your analysis and the market's fear. This disciplined investing process is what allows you to be greedy when others are fearful, because your greed is not an emotion. It is a calculated response to a large and identifiable margin of safety. Let's translate this into an applicable mental model, a blueprint for ensuring every investment you make has a built-in margin of safety. This requires a shift in mindset. You must accept that valuation is not an exact science, but an art of conservative estimation. First, understand that value is a range. Your goal is not to pinpoint a single, precise, intrinsic value for a company. That's impossible. Your goal is to determine a reasonable, conservative range of value. Thinking in terms of probabilities and ranges, rather than false precision, is a hallmark of a professional investment process. Second, focus on owner earnings. To value a business, you need to understand its true cash-generating power. Buffett uses a concept he calls owner earnings. A simplified but effective proxy for this is free cash flow. You can calculate this as net income plus depreciation and amortization minus maintenance capital expenditures. This figure represents the cash left over for the owners after the business has maintained its current operations. This is the number you should be focused on, not the often misleading reported net income. Third, use a simple discounted cash flow (DCF) model. This sounds intimidating, but the concept is simple. You are estimating all the cash the business will generate from now until Judgment Day and discounting it back to what it's worth today. A practical approach is to project the owner earnings for the next 10 years at a conservative growth rate. Then, you estimate a terminal value, which represents the value of all cash flows after year 10, usually by applying a conservative multiple to the 10th year's earnings. Finally, you discount all of those future cash flows back to the present, using a reasonable discount rate. Your discount rate should be what you could earn in a very safe investment, like a 10-year treasury bond, plus an equity risk premium of a few percentage points to compensate you for the extra risk of owning stocks. Fourth, and this is the core of the checklist item, demand the margin of safety. Once you have your conservative estimate of intrinsic value, let's say you calculate it to be $100 per share, you do not buy the stock at $95. You do not buy it at $90. The rule, as laid down by Benjamin Graham, is to demand a significant discount. A good rule of thumb is to look for a 30% to 50% margin of safety. This means you would only become a buyer of this $100 value company if the stock price fell to somewhere between $50 and $70. This discount is your protection against bad luck, errors in your own judgment, or unforeseen problems in the business. Fifth, practice patience. The consequence of this discipline is that you will spend most of your time doing nothing. Great companies rarely trade at huge discounts to their intrinsic value. You must have the patience to wait for the opportunities, which often come during times of market-wide panic or when a specific company is hit by bad but temporary news. This inaction is the hardest part for most people, but it is the key to unlocking the power of this principle. Your checklist forces you to wait for the perfect pitch. The antithesis of the margin of safety investor is the growth at any price investor. This is the path of the 99% during bull markets and speculative manias. This investor correctly identifies a wonderful business. It's in their circle of competence, has a huge moat, and great management, but they become so infatuated with the company's prospects that they completely ignore the price they are paying. They rationalize that for a company this great, valuation doesn't matter. This is one of the most dangerous and seductive fallacies in all of finance. History is littered with the wreckage of investors who bought great companies at terrible prices. The classic case study is the Nifty 50 era of the early 1970s. This was a group of about 50 large-cap, blue-chip stocks like Coca-Cola, IBM, Xerox, and Polaroid that were seen as one-decision stocks. You could buy them at any price and hold them forever because their growth was supposedly unstoppable. They were fantastic businesses. The problem was that by 1972, the market had bid them up to astronomical valuations with price-to-earnings ratios of 50, 60, or even 100. They were priced for perfection, and then some. When the brutal bear market of 1973-74 hit, these stocks collapsed, falling 50%, 70%, even 90% from their highs. Investors who bought at the peak, despite owning shares in some of the best companies in the world, suffered catastrophic losses. For many of these stocks, it took over a decade just to get back to break even. The lesson is brutal and clear. Price is what you pay, value is what you get. No business, no matter how wonderful, is worth an infinite price. The 99% repeatedly forget this. They get caught up in the story, the excitement, and the rising stock price, and they abandon the discipline of valuation. They pay for a decade of future growth in today's price, leaving themselves with no margin of safety and, consequently, no room for error and no prospect of satisfactory returns. The direct financial connection between the margin of safety and your portfolio's performance is twofold and profound. First, and most obviously, it is the ultimate tool for risk management. Its primary purpose is not to maximize gains, but to minimize the odds of a permanent loss of capital. If you buy a stock valued at $100 for $60, and it turns out your valuation was 20% too optimistic and the company is only worth $80, you still have a good chance of making a profit. If the company stumbles and its value falls to $50, your loss is minimal. However, if you had bought that same stock at $110, the same valuation error or business stumble would result in a devastating loss. The margin of safety is the shock absorber for your portfolio. It is the buffer that protects your capital from the inherent uncertainties of the future. This is the foundation of any sound wealth management strategy. Second, while its primary function is defensive, the margin of safety is also the source of extraordinary returns. By definition, buying $1 of value for 60 cents is a highly profitable activity. When the market's temporary pessimism fades and the stock price eventually rises to reflect its true intrinsic value, the investor who bought with a margin of safety realizes a substantial capital gain. This is how you achieve market-beating returns. It's not by timing the market or predicting short-term price movements. It's by systematically identifying and purchasing assets for less than they are worth. The larger the margin of safety at the time of purchase, the lower the risk and the higher the potential return. This counterintuitive relationship, lower risk leading to higher returns, is the magic of value investing, and it is unlocked entirely by the discipline of the fourth checkbox. It is the rational engine that drives portfolio growth and paves the way to financial freedom. We have arrived at the fifth and final pillar, the last checkbox that ties the entire investment philosophy together. After verifying that a business is understandable, has a durable moat, is run by trustworthy managers, and is available at a significant discount to its intrinsic value, there is one last question to ask. Does this business have favorable long-term prospects that I can envision holding it for decades? This is the forever checkbox. It is the ultimate antidote to the short-termism that plagues the modern financial world. This principle forces you to elevate your thinking from that of a stock trader who rents stocks for a few months to that of a business owner who intends to partner with the enterprise for a lifetime. It is a commitment to harnessing the true engine of wealth, the power of compounding. The quintessential story illustrating this long-term perspective is Warren Buffett's monumental investment in the Coca-Cola Company in 1988. Following the Black Monday market crash of October 1987, investor sentiment was still deeply pessimistic. But Buffett saw an opportunity. He had been observing Coca-Cola for 50 years. He saw a business that checked all his boxes. It was simple to understand. It sold syrup concentrate for a tiny fraction of the retail price of a Coke, letting its bottlers do all the heavy lifting. Its economic moat was arguably the most powerful in the world, a brand name recognized in every corner of the globe, synonymous with happiness and refreshment. It had excellent management focused on expanding its global reach, and after the crash, its stock price was reasonable. But the final, decisive factor was his analysis of its long-term outlook. He wasn't thinking about the next quarter's earnings or the economic forecast for 1989. He was thinking about the next 50 years. He looked at the per capita consumption of Coke in the United States versus the rest of the world and saw a massive, multi-decade runway for growth. He reasoned that as developing nations grew richer, their citizens would adopt the same simple pleasures as Americans, and drinking a Coke was one of them. The product itself was timeless. It wasn't going to be disrupted by technology. The desire for a cold, sweet, refreshing drink was a permanent feature of human nature. He saw a business whose future was not just predictable, but fantastically bright. Based on this long-term conviction, he invested over $1 billion, representing nearly a quarter of Berkshire Hathaway's entire portfolio at the time. It was a massive, concentrated bet, and it paid off spectacularly. That single investment has compounded for over 3 decades, generating tens of billions of dollars in capital gains and dividends for Berkshire shareholders. It was a decision made possible only by checking that final box, by having the vision to look past the short-term noise and focus on the enduring, long-term power of a truly great global franchise. The psychological biases that the forever checkbox helps an investor conquer are deeply ingrained in our human nature: hyperbolic discounting and myopic loss aversion. Hyperbolic discounting is our brain's tendency to strongly prefer smaller, immediate rewards over larger, later rewards. We would rather have $100 today than $120 in a month. This is why people struggle to save for retirement. The immediate pleasure of spending is more tangible and compelling than the abstract, distant goal of a comfortable future. In investing, this bias manifests as a constant temptation to take small, quick profits. We see a stock is up 20%, and our brain screams, "Sell it! Lock in the gain!" The forever principle is a cognitive tool to fight this impulse. It forces you to reframe the decision. The question is not, should I take this 20% gain, but is there any better business in the world I could own for the next 20 years? More often than not, the answer is no, and the correct decision is to do nothing and let the winner keep running. Myopic loss aversion is a related concept. It describes how we are tormented by the short-term fluctuations in our portfolio. We feel the pain of a daily or weekly drop in our stocks far more intensely than we appreciate the massive potential for long-term gains. This short-sighted focus on volatility causes investors to trade constantly, trying to dodge the downturns and catch the upturns. The result is almost always disastrous. The forever checkbox acts as a mental filter. It encourages you to ignore the noise of the daily market swings and focus on the signal of the underlying business's long-term progress. If you truly intend to hold a business for a decade or more, then a 10% drop in its stock price due to a bad quarterly report is not a crisis, it is an irrelevant blip. By consciously adopting an extremely long time horizon, you can psychologically insulate yourself from the market's manic depressive behavior and the emotional turmoil it creates. Let's build the final blueprint, the mental model for evaluating the long-term outlook of a business and cementing this principle into your investment checklist. First, apply the 10-year test. Look at a business and ask yourself, with a high degree of confidence, can you predict what its industry and its competitive position will look like in 10 years? For a company like Wrigley's Chewing Gum or McCormick Spices, the answer is likely yes. The product is simple and enduring. For a company on the bleeding edge of a rapidly changing technology, the answer is much more difficult. This test naturally filters for businesses with stable and predictable futures, the kind that are suitable for long-term compounding. Second, identify secular tailwinds. Is the business being pushed forward by a powerful, long-term societal or economic trend? For example, a company that provides services to an aging population in the developed world is benefiting from a powerful demographic tailwind. A business that provides essential components for data centers is benefiting from the secular trend of digitization. Investing in a company with a strong tailwind at its back is like sailing with the wind rather than against it. It makes everything easier and increases your odds of success. Third, assess its resilience to disruption. In today's world, no business is entirely safe from disruption. You must critically assess how vulnerable the company is to changes in technology or consumer behavior. Is it an incumbent that is likely to be a victim of disruption, like a traditional newspaper? Or is it an innovator that is driving the disruption? The key part of a long-term outlook is finding businesses that are either immune to disruption or are the ones causing it. Fourth, analyze its pricing power and its relationship with inflation. Over a multi-decade holding period, inflation is a silent killer of returns. A business that can consistently raise its prices at or above the rate of inflation without losing customers has a massive long-term advantage. This is directly tied to the strength of its economic moat. This ability to protect its profit margins from being eroded by inflation is a crucial determinant of its long-term value creation. Finally, apply the rocking chair test. This is a simple but powerful visualization. If you were to buy this stock today, put the stock certificate in a safe, and then sit in a rocking chair on your porch for the next 10 years, never once looking at the stock price, would you feel comfortable and confident in your investment? This question forces you to strip away all the short-term market noise and focus exclusively on the quality and durability of the underlying business. If the thought of not being able to sell for 10 years fills you with anxiety, it is likely not the right kind of business for a long-term hold. The antithesis of the long-term owner is the speculator, the trader. This represents the path of the 99% who are glued to their screens, obsessed with the daily, hourly, and even minute-by-minute gyrations of the market. Their investment process is a chaotic reaction to the newsfeed. The Federal Reserve chairman says something about interest rates, they sell. A company beats earnings estimates by a penny, they buy. A geopolitical headline flashes across the screen, they panic. They mistake this frantic activity for progress. They believe they can outsmart the market through rapid-fire trading. But all the evidence shows that this is a loser's game. The 99% are constantly churning their portfolios, buying high in moments of euphoria and selling low in moments of panic. Their trading psychology is entirely reactive. They have no long-term philosophy, no sense of business ownership. They are treating the stock market like a casino, and the house always wins. Academic studies have consistently shown that the more an individual investor trades, the worse their returns are. They are decimated by transaction costs, by bid-ask spreads, and most importantly by the taxes they have to pay on their short-term capital gains. They never allow the magic of compounding to take root. They are constantly pulling up their saplings to see if the roots are growing, and in doing so, they ensure they will never have a mighty oak. The direct financial connection between a long-term holding period and the achievement of financial freedom is perhaps the most powerful in all of finance. It is the secret sauce of wealth creation, the untaxed compounding of capital. When you buy and sell a stock within a year, any profit you make is taxed as a short-term capital gain, which is taxed at your highest ordinary income tax rate. When you hold a stock for more than a year, it is taxed at the much lower long-term capital gains rate. But the real magic happens when you hold for many years. By not selling, you are allowing your entire investment, your original principal, and all your accumulated gains to continue working for you, growing on a tax-deferred basis. This is a massive, and often overlooked, financial advantage. It's like having an interest-free loan from the government. Two investors can earn the same 10% annual return, but the one who holds for 20 years will end up with dramatically more wealth than the one who sells and pays taxes every year, simply because of the power of tax-deferred compounding. This is the ultimate engine of portfolio growth. Adopting the forever mindset shifts your entire approach from seeking quick profits to building lasting wealth. It is the final, crucial checkbox that transforms you from a speculator into a true investor, a partner in great businesses, and puts you on the surest path to achieving genuine and lasting financial freedom. You have just been given a powerful weapon. This 5-point checklist, the circle of competence, the economic moat, management quality, the margin of safety, and the long-term outlook, is more than just an investment tool. It is a complete system for rational decision-making in an irrational world. It is the shield that will protect you from the emotional ghost that lives in the market, the ghost of fear and greed that has sabotaged the financial dreams of so many. By committing to this disciplined process, you have taken the single most important step away from being a gambler and toward becoming a professional, a true business owner. You now possess the very framework that has been the foundation of one of the world's greatest fortunes. You have invested your time, and in return, you have acquired a mental arsenal that can serve you for a lifetime. But it is crucial to understand that what you have just mastered is one essential component in a much larger, interconnected network of mental models. This checklist is the engine, a powerful machine for processing information and making decisions. But an engine, no matter how powerful, is useless without a map and a deep understanding of the terrain. The checklist tells you what to look for in a business, but there is a deeper philosophy that informs how to think about markets, how to understand investor psychology on a mass scale, and how to allocate capital not just between individual stocks, but across an entire portfolio through the inevitable cycles of boom and bust. What you have learned is a vital piece of the puzzle, but it is not the entire puzzle. The video that is now appearing on your screen is the next piece of that map. It is the link that connects the tactical, company-specific analysis you have just learned to the broader, strategic understanding of market dynamics. If today was about building the perfect car, that next video is about learning how to navigate the entire highway system with all its traffic jams, detours, and open roads. It provides the operating system, the philosophical software that makes this checklist hardware run at its full potential. You have forged the sword. The next step is to master the art of swordsmanship. The choice to click is more than just a choice to watch another video. It is a declaration of your intent. It is the choice to continue your ascent, to move from being an investor who has a system, to becoming a thinker who understands the very principles that make the system work. Complete your arsenal. The journey awaits.